another video, financial statement analysis. We made the last video for the German-based energy companies. We're going to go into materials now. We're still in Germany. We have a lot more to do for Germany, so we're only in the second category, which is materials. So let's start with Auribis. Check the charts. Let's just check. So almost 100% performance, positive performance over a lifespan of so about a year. 2020. No, sorry, that's wrong. 2012. Okay, so that's about 9 years. About 9 years, 90%. I would definitely say that is really bad. That is 9 years. That's about 10% a year. That's like the basic. I wouldn't say it's horrible. I'd just say it's like the basic minimum level of return on investment that you would expect from a stock. That's if you weren't really doing any research or anything. You've done a little bit of research, and you kind of done a little bit of research across the board, and then found a few stocks and then put your money in whichever one you thought was the best. But 10% return is probably the minimum. But it's still decent. It's not horrendous, but it's not the worst. Let's look at performance. As you can see, I invested £1. All of the stocks that we analyze, if you see any that have cash already invested, first of all, it won't be much. It'll be like £1 on average. And if you ever see money invested already, it was probably invested about 6 months ago, because that's when I had done the investment in all of the stocks. So 3% negative. I've lost about 3% of the money. We're going to skip company details because we don't really need to look at that. We're looking purely at the financials to analyze how great an investment this company is, or the particular company we're looking at. 7,000 employees. It's always good to have a lot of employees. Of course, if you're managing the finances properly, then it's even better. But 7,000 employees is really good. Basic materials. Let's look at the Q ratios. Market cap in the billions, which I like. 3 billion. It's definitely large cap, probably lower level large cap. P ratio 11, which is awesome. We're looking at as little as possible. Around 10 is really good, really healthy. Anything lower is a bit risky, because the company probably isn't very stable. Anything higher, yeah, it might be just a bit of enthusiasm from the market, maybe overvalued. Revenue 12.43 billion, which is awesome, but we need to always look at the profit margin and net income, which is how much of the revenue we're taking home. 6.63 euros as the earnings per share. The stock price is 78 euros. So 6 euros is not very much. It's just about 10%, which is not. It's not bad. It's not bad. I think it's all right. Dividend yield is very low, almost 2%, but I've seen worse. 2% is not great, but it could be lower. Some companies don't even pay any dividends, so it could be worse. The beta is 1.1, so it's about 10% higher than the average, which is 1. Financial summary, we're going to skip that also. Let's look at the statements, the 3 big statements. So as you can see straight away, the profit margin on this company is very low. 2020, so it skipped one financial year. It's supposed to have the current financial year, which is 2021, but it doesn't. So it's got the last financial year and the 2 years previous. Profit margin has been about 2, which is around the same as the commercial retail sector, which is they tend to be large companies, but this company it's not so large to justify such a low profit margin. But oh well. Balance sheet, it has a lot of debt, about 50%, about 50%, and it's been the same across the past 4 financial years, I think. So if it's got such a low profit margin, which makes it even worse than the last company we analyzed in terms of take-home pay. If it's got such a low profit margin, it shouldn't have so much debt, because the interest rate would just evaporate all of the profit margin, also all of the profit. So there's no point at investing in a company like this. Probably why it's performed so poorly. Lastly, the net change in cash in the cash flow statement: 39 million euros positive, 2019 negative, So we have about 2 million plus. 2018, 91 million negative. So overall, a net change in cash of negative 89 million for the past three financial years, excluding the current, which is not great considering all the other positive aspects of the financials are poor. Profit margin of 2% average. So overall, this company is not a great investment. So if you're ever looking to invest in a company, I wouldn't recommend Auribis. Correct me if I'm saying it incorrectly, but shockingly, it's actually performed pretty well over the lifespan. But maybe its performance is it's mediocre performance. Because I'll classify its performance as mediocre. Its mediocre performance is purely based on the fact that its debt to asset ratio isn't so high. It's below 50%, and it still has a profit margin, because a lot of companies don't have negative profit margins. So I would probably say that's probably the sole purpose of its positive performance over its lifespan. And you have to consider it's taken 9 years for its stock price to not even double. It hasn't even doubled yet, so it's taken 9 years. So thanks for watching. See you in the next one.